A woman sits at her kitchen table before sunrise, staring at a retirement statement that still looks respectable. The number has not collapsed. Nothing on the page is screaming emergency, but the cost of food, insurance, housing, and medicine has been climbing around her for years. And without anyone touching her account, part of her life has already been taken. If you like following the quiet shifts before they become front page panic, stay close to this channel, because this is one of those moments where the story sounds like finance, but it ends up touching your paycheck, your home, your savings, and the shape of your future. Ray Dalio's warning lands hard for one reason. The wealth transfer is not a future event waiting for permission. In many ways, it is already moving. When people hear the phrase wealth transfer, they often imagine one dramatic event: a crash, a default, a bank run, a market collapse with red numbers everywhere. But most big transfers do not arrive like a thunderclap. They begin like fog, slow, quiet, and easy to mistake for normal. That is why this matters to regular people even more than it matters to traders. You do not need to own a hedge fund to be affected by a debt cycle. You only need to live on wages, keep money in the bank, save for retirement, hope your home stays valuable, or depend on a future promise from a pension, a bond, or a government program. That includes almost everyone. When Dalio talks about wealth transfer, he is not just talking about rich people getting richer. He is describing the movement of value from one kind of claim to another, from paper promises to hard assets, from fixed income to flexible ownership, from people who trust the old system without question to people who understand where the stress is building. Think of it this way. If you hold cash, a bond, or a salary that stays mostly fixed while the cost of life keeps rising, you may still have the same number of dollars, but those dollars command less of the real world. Less energy, less food, less housing, less time. That is a transfer, even if no one sends you a memo saying it happened. At the center of this sits debt. Debt is borrowed money that must be repaid later. When debt grows much faster than income, an economy starts depending on low interest rates, new borrowing, and constant support just to keep moving. That works for a while until the weight becomes too heavy to ignore. Then the system gets trapped. If rates stay low for too long, inflation can rise and savers get hurt. If rates rise too far, debt payments become painful for households, companies, and governments. If policymakers print more money to ease the pain, the currency can lose purchasing power. If they do not, parts of the system can break anyway. That is why late-stage debt cycles feel confusing. No option is clean. Every choice shifts pain from one group to another. One year, the damage lands on people living on fixed income. Another year, it lands on borrowers, workers, small businesses, or pension funds. The transfer keeps moving, but it keeps happening. Picture a couple in their early 60s. They did what they were told. They worked, paid down debt, kept emergency savings, bought a modest house, and built a retirement account full of bond funds and broad market exposure because that was considered responsible. They were not reckless. They were disciplined. Now look at their world. Their account statement still looks decent in dollar terms, but their property taxes are higher. Their health coverage costs more. Their grocery bill feels strange every single month. And if they want the same standard of living 10 years from now, the math is no longer working the way it once did. A person can lose wealth in two ways. The first is obvious. The balance falls. The second is quieter. The balance rises a little, but life rises faster. If your savings earn 3% and your real living costs climb 5%, you are not standing still. You are moving backward in polished shoes. That is one reason this transfer hides in plain sight. People are trained to watch nominal numbers. Nominal means the face value written on the page. But real wealth is different. Real wealth is what your money can actually buy after inflation, taxes, and rising basic needs take their cut. If this kind of calm signal hunting helps you see the pressure before it shows up in headlines, keep watching with me, because the next layer is where this stops being a market story and starts looking like a map of who gets squeezed first, who gets protected, and why that pattern keeps repeating. It is not random, it is structural. The first people hurt are often the people who seem safest: cash savers, retirees, pension holders, workers with modest wage growth, not because they made wild bets, but because they rely on fixed claims in a system that is trying to soften a debt burden. And the easiest way to soften a debt burden is to let money lose value slowly. That sounds unfair because it is unfair. A government deep in debt benefits if old debt gets repaid with cheaper money. A homeowner with a fixed mortgage can benefit if wages and prices rise while the monthly payment stays the same. But the person sitting on cash feels the opposite effect. Their money gets lighter while their future gets heavier. This is where many people get the story upside down. They think wealth transfer only means the poor lose and the rich win. Sometimes that is true, but often the deeper split is between owners and holders. Owners of productive businesses, useful land, scarce resources, and assets with pricing power can adjust. Holders of long-term promises often cannot. Pricing power matters more than people realize. It means a business can raise prices without losing all its customers. That kind of asset can defend itself when the currency weakens. A long bond cannot do that. A savings account cannot do that. A fixed pension check usually cannot do that either. Now, a reasonable person might say, hold on, inflation is not exploding right now. Markets still function. People are still employed. If the wealth transfer had really started, would it not look more dramatic than this? That doubt makes sense, but it misses how these cycles behave. Big shifts often begin after the panic, not during it. First comes the visible crisis, then comes the response, then comes the long after effect where debts remain huge, trust becomes thinner, and policy choices quietly favor stability today over purchasing power tomorrow. The headlines fade, but the transfer continues underneath them. That is why waiting for official confirmation is so dangerous. By the time the language becomes mainstream, prices have adjusted, opportunities have narrowed, and defensive assets are often already expensive. The people who protect themselves early rarely look brilliant at first. They often look boring, patient, or even overly cautious. Only later does their positioning make sense. If you have ever looked at your savings and wondered whether the numbers are growing while your future is shrinking, that question alone is worth staying for, because it means you are already noticing something most people feel emotionally long before they can explain it clearly. The discomfort is not imaginary. It is often the first sign that the measuring stick itself is changing. Now widen the lens. This is not only about one retirement account or one household budget, it is also about the world order that sits behind money. When a country carries very large debts for a very long time, confidence becomes part of the balance sheet. And confidence is strong until suddenly it is not. The dollar still sits at the center of the global system. That matters because global trade, reserves, and finance have been built around trust in dollar assets for generations. But when debt climbs, deficits stay large, and interest costs swell, more countries begin asking a quiet question. How much of our future do we want tied to someone else's promises? That is one reason gold keeps coming back into the conversation. Gold does not pay interest. It does not produce cash flow, but it also does not depend on a central bank keeping a promise. In a world where trust in paper claims gets thinner, gold starts acting less like a relic and more like neutral collateral. Notice what many central banks have been doing in recent years. They have been adding gold, not because they expect the world to end tomorrow, but because they understand the value of owning something outside the liability of another nation. That is a fancy way of saying this. If trust shifts, hard reserves matter. Bonds tell a similar story in reverse. A bond is a loan you make to a government or company. It can feel safe because the income is fixed. But fixed income becomes fragile when inflation is sticky, debt is high, and future policy is uncertain. You may get every dollar back and still end up poorer in real terms. This is where many retirements become more exposed than people think. People spent decades being taught that a traditional mix of stocks and bonds could handle almost anything. And for long stretches, it worked beautifully. But that model came from a period of falling interest rates, expanding credit, strong globalization, and rising trust in institutions. The next stretch may not look like that at all. If this long view way of thinking earns a place in your weekly routine, keep the channel nearby, because the hardest part of these cycles is not finding data. It is keeping your mind steady while the system sends mixed signals. One month it rewards risk, the next month it rewards caution. Without a framework, people get pushed around by noise. So where could this go from here? There are not just one or two possible futures. There are several realistic paths, and the transfer looks different in each one. That is important because positioning is not about predicting one perfect outcome. It is about building enough resilience to survive more than one version of the future. The first path is the slow grind. Growth stays weak but not catastrophic. Inflation cools from the peaks, yet daily life remains permanently more expensive than people expected. Rates move up and down, but debt stays huge, so policymakers keep leaning toward support whenever stress appears. In that world, cash feels safe, but quietly underperforms real life. The second path is a sharper recession, followed by a bigger rescue. Asset prices fall, confidence cracks. Unemployment rises, then the response arrives through lower rates, more liquidity, and renewed support. That may save the system in the short run, but it can restart the same transfer by weakening the purchasing power of money again. The third path is the hopeful one. Productivity rises fast enough to help carry the debt burden. Technology makes workers more efficient. New industries expand. Growth improves without runaway inflation. That would be the cleanest outcome. But even there, the benefits would not spread evenly. The biggest gains would still flow first to owners of productive assets and critical infrastructure. So no matter which path unfolds, one message keeps returning. Ownership matters, flexibility matters, scarcity matters, and blind trust in long-dated paper promises becomes less comfortable when the system is trying to manage too much debt with too many political constraints. That is the part people fail to notice until much later. A younger worker feels this differently than a retiree. The retiree worries about preserving purchasing power. The worker worries about catching up at all. Wages rise, but housing, childcare, transport, and insurance rise too. The ladder is still there, but some of the rungs keep moving farther apart. That too is a form of transfer. A small business owner sees another version. Their costs rise first, then customers push back. Then taxes, rent, and financing pressure the middle from both sides. Only businesses with loyal customers, unique products, or strong local demand can pass the cost along. Everyone else gets squeezed between a weaker consumer and a more expensive world. This is why being positioned does not mean making one dramatic bet. It does not mean selling everything and hiding in a bunker. It does not mean going all in on gold, all in on stocks, or all in on cash. Extreme certainty is usually a luxury people feel right before reality humbles them. Positioning is more thoughtful than that. It starts with asking a different question. Not what asset will go up the most next year, but what kind of claims do I own? Do I mostly own promises that depend on stable money, low inflation, and perfect policy? Or do I own some things with the ability to adjust, endure, and retain value when trust gets tested? That question changes everything. For many people, the answer leads to a layered approach. Some liquidity because life is unpredictable. Some exposure to productive businesses because ownership still matters. Some protection in hard assets or stores of value because policy can change the worth of cash. Less dependence on long-term fixed promises alone, especially when the debt burden around them keeps growing. It also means paying attention to duration. Duration is just a measure of how sensitive an asset is to changes in rates and time. The longer the promise, the more exposed it can be when the world changes. That is true in bonds, it is true in business models, and in a strange way, it is true in life plans built on old assumptions. Another part of positioning has nothing to do with markets. It is income resilience, skills that remain useful, the ability to adapt, the willingness to reduce fragile debt in your own life before the system forces the lesson on you. People often search for one perfect asset while ignoring the strength of becoming less breakable. That is also wealth. And there is a mindset shift here that matters just as much as portfolio choices. During easy periods, people confuse rising asset prices with skill. During harder periods, the wiser move is humility. You do not need to forecast every turn. You need to see the incentives. Heavy debt pushes systems toward policies that protect the structure, even if they dilute the saver. That pattern is old. Would you rather own only the promises of a strained system, or would you rather own at least some pieces of the real world that system still needs to function? That question is not dramatic. It is practical. Food systems, energy, infrastructure, strong businesses, useful land, scarce collateral, adaptable income streams. These are not fashionable ideas, they are durable ones. One reason people resist this conversation is emotional. They want the future to resemble the rules they grew up trusting. Save steadily, buy bonds for safety, count on diversification to do the rest. And again, those habits were not foolish. They were built for a world where debt trends, demographics, and global trust were more supportive than they are now. The pain comes from realizing that a strategy can be sensible and still become outdated. That is hard for people to admit. It feels like betrayal. But markets do not care about our attachment to old playbooks. Cycles move, incentives change. And when the monetary foundation shifts, assets that once looked safe can become quietly dangerous. That is why the phrase wealth transfer should not be heard as a slogan. It should be heard as a description of motion. Value is moving from the passive to the prepared, from fixed claims to adaptable claims, from confidence in symbols to confidence in things that can still serve, produce, or protect. The speed may vary, but the direction matters. So if you are asking whether you are positioned, the honest answer is not found in one ticker symbol. It is found in the structure of your life. How much of your future depends on one policy outcome? How much depends on low inflation returning forever? How much depends on institutions behaving exactly as they did during a more forgiving era? That is the real audit. And if this slower, more grounded way of reading the world helps you think beyond the noise, keep a seat here, because the next few years will likely reward people who can stay calm while others swing between denial and panic. That is where good decisions come from. Not from fear, not from hype, from seeing the pressure early and adjusting before adjustment becomes expensive. The hardest thing about a wealth transfer is that it can feel invisible until one day it feels obvious. By then, the saver wonders why safety did not protect them. The worker wonders why effort did not stretch as far. The retiree wonders why the plan no longer covers the life it was built for. And the system, as always, keeps moving forward without apologizing. So listen carefully to the title one more time. The wealth transfer has already started. That means this is not mainly about prediction. It is about recognition. The question is no longer whether the ground is shifting. The question is whether you are still standing where the old map told you to stand. In every great debt cycle, wealth does not disappear. It changes address.